Hello and welcome to a special webinar brought to you by Tech Southwest and Bishop Fleming. It's called Spring Budget 2024, What It Means for Tech Businesses. We'll be cutting through some of the noise of the Chancellor's budget announcement to break down what matters for people in the tech sector. I'm Robert Hillier, host of the Southwest Tech Daily podcast, and joining me today are two leading experts in our sector. We have Pippa Clarke, Chair and Head of Technology, Media and Telecommunications at Bishop Fleming Chartered Accountants. Hi, Pippa.
Hi there.
Ben Cooper, funding lead at Tech Southwest, co-founder of Angel Investors Bristol, and strategic advisor to startup and scale-up businesses. Hi, Ben.
Hi.
So I was fortunate to be in and around Westminster the past couple of days, so got a real sense of what was going on. As we know, much of the budget had been pre-briefed, pre-released, so there weren't any real surprises, including for the tech sector. The Chancellor did, however, reference the UK's tech sector's growth and did outline policies aimed at supporting it. We're on track to become the world's next Silicon Valley, he said. So I'm just going to run quickly through some of the key policies affecting UK tech businesses before we hear more from our guest. So Angel Investors, the Chancellor confirmed he's reversing changes to angel investor rules that raise the income threshold to qualify as a high net worth individual. The rule change came into effect at the end of January, and it raised the income requirement to receive investment protections from 100,000 to 170,000. Our guest will definitely explain more about that. There's been some criticism of the Treasury from the tech sector, as it was believed that the cut-off of angel investors from supporting small businesses who are predominantly women from minority backgrounds and those based outside of London was having a real negative impact. Around research and development, on Monday, actually, the Chancellor had already announced a package of 360 million split between state and industry to support British R&D and manufacturing. This was 92 million for life sciences, 200 million for clean aviation technology, and 73 million for electric vehicle development. There was no mention of structural reform of the R&D tax credit scheme or an increase to the amount companies can claim, which many had been hoping for, but there was a stated commitment to improve the functioning of the tax relief system. Pension funds is becoming an important area of interest for the Conservatives and Labour at the moment, and they've been exploring ways to drive the billions of pounds held by pension funds towards the UK startup and high growth companies. It's identified by both parties as a reason why we lag behind the United States. There's a requirement for pension funds to disclose how much they invest in UK businesses compared with those overseas. They'll also be required to compare performance data against competition, and poorly performing schemes won't be allowed to take on new business from employers. There was also the announcement of the British ISA as well, which was geared towards funneling retail investment into UK companies with an additional 5,000 annual investment allowance. Pippa will tell us more about that. Universities featured as well around their spin-outs. They're going to be asked to report on their spin-out policies by the end of May. The Treasury commissioned a report last year into spin-outs, which said that universities should take reduced stakes in startups to encourage more investment into them, to create a more level playing field. And they also want to consult for a pilot aimed at establishing a shared approach and reporting mechanism around commercial innovation through tech transfer offices or TTOs. AI quickly, £100 million funding package for the Alan Turing Institute, which is the national AI and data science research body, £74 million for an AI upskilling fund for SMEs, and a lot of the savings and productivity improvements in public services were based around AI as well, particularly with the NHS. And then a bit of levelling up at the end, expanded funding for 6 tech-focused investment zones, Greater Manchester, South Yorkshire, multi-million-pound investments for manufacturing, Liverpool for life sciences, the North East for electric vehicles and offshore wind, money for the West Midlands battery technology, sustainable construction technologies. Scotland and Canary Wharf also got some money, no mention of the Southwest in there at all. And as always, lots of tax information that's relevant to our sector. Pippa, can you take us through some of those, please?
Yes, of course. Thanks, Robert. So I guess it's worth just starting by saying, we have a backdrop where the interest rates, although they've stabilised, are still a bit higher than businesses and individuals had become used to. They may start to fall later this year, but that's not yet currently known. Inflation has come down from its big high, but it's still higher than the Treasury and the Bank of England want. But it may allow them to ease some of their monetary policy. And we have growth, but we did enter a technical recession at the end of 2023, and the growth is anticipated to be fairly modest. So against that backdrop, it has been a little difficult for the Chancellor to do any big giveaways. But what there has been is the retention of some key features that are particularly relevant to the tech sector. So just running quickly through what some of those are, there's a beneficial share scheme called the EMI share scheme, which is available, that allows businesses to reward their employees with share options when, for instance, there may be a preference to doing that rather than paying out cash salaries. That has been retained. That's really valuable to the tech sector, where that's quite a feature that we come across regularly, where there is this desire to allow equity investment by employees, particularly where they're involved at an early stage, and actually there's limited cash available to pay them in cash. The way that works is that it says if you grant an option and you meet all the conditions, instead of later on when that option is exercised, the value of the shares that the option has been exercised over is then subject to income tax and national insurance. That is exempt from income tax and national insurance. It's only taxed and subject to NIC based on the value of the shares at the time the option is granted. So in a high growth tech business, that can be a really valuable tax relief and act as a big incentive for the employees to stay, even though their cash wage and their cash salary might be less than they could get elsewhere in a bigger, more established tech business. So the retention of that, I think, is really key. Another piece which can act, of course, to bring cash back to the business at an early stage is the R&D tax credit regime. Now, we've got some sort of good and some bad news here. From last year, there is an extension of the definition of qualifying costs. So that now includes cloud computing costs and pure mathematics, whereas previously costs on those areas were not eligible to be included in an R&D claim. But on the sort of downside, we've got a new requirement for an advance notification. So a company which has never claimed R&D tax credits, or where there hasn't been a claim within the last 3 years, now needs to submit an advance notification of that claim to HMRC within 6 months of the end of the accounting period for which it has a claim. So previously, we used to be able to do a claim until up to 2 years after the end of the year in question, and that's now come down to 6 months for the first ever claim.
And what would be the reason for that, Pippa? So what would be the reason for making a change like that?
The reason for that is because there's, and this is part of a regulatory initiative that we're seeing coming out of HMRC. The reason for that is because there were some well-documented cases of those who are not tax experts helping companies to make R&D claims. Those claims going in quite late and not being robust or actually in accordance with the way the tax legislation is designed. So this prevents a business from doing a late claim, because there's this advance notification which requires certain information to be disclosed. There's more rigor around the types of claims that are going in. We have seen an increase in the inquiries that come out of HMRC to look at whether a claim is in fact a valid claim. So historically, we would see a small number of inquiries into R&D claims out of HMRC compared to the volume that were going in. And those inquiries tended to be very specific about the nature of the expenses that were being claimed for. The change is that those inquiries are now, there's a much higher volume, and the inquiries are coming back to the fundamental question of, actually, is this really R&D as defined for the purposes of the tax credit system? There's a lot of industry lobbying from the tax profession to encourage HMRC to become better at that, because there's a large volume and not all of those inquiries are being handled in a particularly helpful way, and HMRC are being quite intransigent, and clients are, some businesses are deciding to give up on their claims if it's a relatively small amount, which is skewing the data as to how many are successful in terms of that approach by HMRC to increase the number and get some tax revenue out of that. And the other piece that we have is that HMRC are refusing to settle, and so clients are, if they want to pursue it, they're having to go much further than they previously would. So it's not just a case of dialogue with an inspector at HMRC. Sometimes we're having refusals of a request to meet or to speak to resolve a question, and the client is having to go to an arbitration procedure within HMRC to try and get these things moved forward. So
Very
that
clear. Thank you.
That has changed, and also since last year, it's now a requirement that before a claim goes in, an additional information form has to be submitted as well, and that is a mandatory online form that captures comprehensive claim details and data. So it used to be that there were some practitioners who were perhaps not actually tax practitioners, but some advisors who were putting in R&D claims on behalf of clients without sufficient backing evidence to show why there was a valid claim. And this additional information form now means that you cannot make a claim unless you put in good details as to why the claim is valid.
So just on the R&D tax credit, so although I think the government do recognise, or in the budget they did recognise the fact there's some procedural issues, I think, with people making credits, and I believe they announced the formation of an expert advisory panel to support HMRC with the administration of R&D tax relief. So I think they do recognise that companies, because these are very valuable reliefs to companies.
These matters have been raised in Parliament as to the effect that it's having, that there are so many inquiries being raised, and the difficulties that taxpayers are having in getting those resolved. So yeah, it's been a big subject, and there is already a joint HMRC and in tax professional industry meeting facility, which one of our specialist R&D people participates in terms of that. So it's going to be interesting to see what additional measures, what else this new body can do on top of what is already being done. But you know, that said, this is still a valid claim where there is R&D, and businesses should be claiming it. And even with the changes, there's been a merging of an old and an SME scheme and a large company scheme, which means that the rates have come down a bit for the SMEs and up a bit for the large company schemes as to what they can get. But some companies can still get an effective tax saving of up to 27% of what they're spending on the R&D. So it's really worth it.
Absolutely.
Pippa, sorry, I was going to say I will come back to you on the on some of the changes to the creative sector. Is there anything else that we need to run through specifically around some of the tax information now that people need to be aware of?
No, I think, you know, that was what I wanted to bring out about the R&D reliefs. The R&D reliefs are really valuable. I guess it's also worth, before we come on to the creative sector, perhaps focusing on EIS and SEIS, but we can do that now or later.
No, do it now. That's fine.
So the key message here is that they're still available. So the SEIS scheme is, you know, where a company is less than 3 years old, they can raise up to £250,000 under the SEIS scheme, and it gives really good benefits for investors to attract them into those higher risk companies. There are all sorts of conditions that apply with any relief, and that's no different here. It has to be a small company, so less than 25 employees, but that income tax relief of up to 50% for on the way in, and 50% reinvestment relief in relation to any gains that have been made. So an investor who's already made a capital gain can reduce the tax on it by 50% with their SEIS investment. So as I say, lots of conditions. It's still there for a qualifying company. It can be a really useful way to encourage investors to commit to the business. And then something available when you need more than £250,000, or if the business is slightly more mature, is the EIS scheme. So that's, you know, a maximum of 12 million that can be raised, so a much higher limit, or 20 million even if it's a knowledge intensive company as defined. Some more conditions around that. It's available for bigger businesses. You can have up to 250 employees or up to 500 if it's knowledge intensive. And and you can have some quite significant gross assets on the balance sheet as well. But again, that's a valuable relief for the investor. Up to 30% of what is put in can come back as an income tax credit, and the whole of any capital gain can be deferred. So capital gains tax can be completely deferred until later on when you've realised the investment in the EIS business. And then on the way out of, you know, an SEIS or an EIS, when those shares are sold, there's a liquidity event. Though any capital gain is completely exempt for the investor. So again, a really valuable relief on the way out. And we have to acknowledge that these are higher risk type investments. So if they do make a loss, there are some tax losses available where they've put money in and haven't been able to recover all or some of it on the way out. So those, I think, are really worth bearing in mind. And obviously it's the company that has to go through a lot of the hoops to get that EIS or SEIS relief for the investor.
Pippa, thank you. Very thorough, as always. Ben, I'd like to get your thoughts around the reversal of the regulations around angel investors and what this might mean and why the change was deemed necessary.
I think I think you're right. And you pointed out during your intro, Robert, that it had created quite a stir in the market around these significant increases to the limits. And I think we just need to look at why those limits were initially introduced. So when those exemptions were put in place, I think it's over 10 years ago, those figures have never been increased. And so really what they were doing was just bringing them back into line with inflation. However, I think what they didn't understand was the unintended consequences of those changes. And they were very quickly brought to their attention that those types of figures reduced the pool of potential angel investors in the UK, reduced it dramatically, but also had a disparate effect on female and underrepresented communities, particularly in the people who to become angel investors. And so I think it's an incredibly positive move. I think there's even the current regime still it requires reform and amending, but I think it's a very positive thing for angel investing, because we were just a minute ago we were talking about SEIS and I was talking about SEIS and EIS. These are all reliefs that are available to potential investors and private investors into early stage businesses and tech companies, and they're very important. But if those individuals can't take advantage of those reliefs, obviously the tap gets turned off. The government is very keen to attract private investment into the tech sector and all sectors, but the tech sector in particular. And so by turning that tap off, by increasing those limits, it potentially had a significant impact on those companies that need to raise money. The thing we need to understand is that the government uses lots of different levers to inject money into the tech community, and obviously many of the announcements that were made yesterday, and some re-announcements, but about this huge amounts of investment they're putting into the various different projects and pots of money that they're making available. A lot of those pots are grant-based and often require match funding. So their Innovate UK is their sort of main deliverer of grants into the sort of innovative sector. Many of those grants require match funding, and that match funding for early stage businesses generally is angel investment. And so with one hand, they're trying to push money into the tech sector to stimulate innovation and to support these innovative companies and these university spin-outs you mentioned. But on the other hand, I think they just need to get a little bit more joined up in their thinking about the unintended consequences of reducing the pool of angel investors. And I think they've very quickly recognised that was an error, and have reversed that and put that back to how it was.
Move to correct it. Pippa, anything to add on that? Otherwise, I'm going to ask Ben one more question before I come back to you.
No, I think go ahead with Ben.
Okay, that's fine. Ben, I didn't include it in my introduction because I didn't quite understand it. So if you could just talk us through Pisces quickly, that would be helpful.
Yeah. So one of the issues for angel investors is duration. What I call duration, or the length of time at which you which you hold in investment, that investment that you're making in an early stage tech company, it could be a medical tech company, life science, they're often very early stage. Technology is not necessarily fully proven, and certainly not been commercialized. And often they have to go, and particularly in those particular sectors, they need to go through a lot of regulatory hurdles before they can even get to market. And so you're tying your investment up for a significant amount of time. And it could be, 7-10 years is not unusual holding periods for an angel investor to invest into a company. Now, that creates liquidity problems for the whole sector itself. So if that money's not being recycled, we're not seeing exit or liquidity events where people, angel investors can realize an investment midway through a company's journey, should we say. It means that money can't be recycled into the sector and stimulate further investment in other companies. So what the government's doing here is it's consulting on creating a system called Pisces, and ultimately that's to create almost a secondary market in unquoted companies. So what they're trying to do, I think, is stimulate that ability for angel investors to be able to sell those shares prior to a full liquidity event or an exit or a share flotation by the company itself. So it creates a market where other investors who may be interested in that company can buy in shares where there isn't a fundraising going on, and say an angel investor wants to remove himself from that company or take their money out of that company for whatever reason, gets an opportunity to do that. So it's a conduit to it. So we've had what we call off exchange secondary markets before. There's a few in the private sector that's starting to materialize, but there seems to be that the government are very keen to create a regulated market, or a market which is monitored and government led, to do that.
Thank you. Much clearer than the government's own documents over that. I understand it now for the first time. Pippa, the creative sector, there was some news around taxation for them, which I think is interesting.
No, it is. And a lot of tech businesses are working in the creative sector, because this applies to film, TV and video games. So for video games, film and high-end TV, there's a credit available for qualifying spend of 20, it amounts to a 25.5% benefit. And for animation and children's TV, that goes up to 29.25%. So that's really valuable. And again, businesses should be claiming it where they can. There is a new restriction, and actually this applies to the R&D system now as well. The relief is restricted to UK expenditure. So where there's a lot of spend outside of the UK on R&D or on film, TV, video games, that isn't going to be qualifying. And that's really about the drive to create the tech and the creative industries, have the UK as a real hub for that, by encouraging the activity to take place in the UK itself. There is one new scheme that was announced yesterday for independent films. So this is something where, say, the budget is less than £15 million. And that has an enhanced rate of relief. And that can have a net effect of nearly 50% for the films. And in visual effects, again, there's a relief that comes in there, and that's nearly 30% of a relief by the time you take into account the fact that these credits are taxable. So, and again, as you would expect with a provision of tax relief, there is a lot of legislation around it. We've had a form of these reliefs for a little while. HMRC have identified that there may be some abuse, and this is likely similar to that which we've seen in the R&D system. They have announced that they will be legislating on measures to counter abuse in this area. But hugely valuable. If if a business qualifies for it, claim it.
And a lot happening in Cornwall around that now, around immersive TV and TV productions. That could be a real boost.
It could be a real boost in Cornwall, and Bristol, I know as well, has TV production.
I was at a creative Devon event on Tuesday evening as well. So it's going to be valuable to similar things going on in sort of Devon area as well. So I think it's going to be very valuable to a lot of them.
If we take a bit of a step back from some of that deep dive there, and the macroeconomic situation is not looking particularly healthy in terms of everything from OBR forecast to Institute of Financial Studies. Do you think that what we heard this week does anything to give people additional confidence around the next few months and years for our sector?
Well, I think there's probably a little more certainty about some of the reliefs remaining on the tax side. What we don't have is certainty around when the current approach to tackling R&D claims from HMRC might change. So that, I think, is quite unsettling, and it affects particularly the tech sector. And where there's a software claim, there can be some questions from HMRC that are not difficult to answer, but where they're not accepting of the answers. So there hasn't been any change announced about that, which is a shame.
Ben?
Yeah, no, I'd agree. I mean, there's definitely a call out in the sector to for certainty and of application and consistency of application of those rules, and it is proving to be quite difficult in certain circumstances to get what are valid claims. Again, it goes back to the point is that the government are stimulating the business, stimulating the economy and stimulating the business to focus on tech, and for us to become a high growth, innovative business, as you say, to become the next Silicon Valley. But it needs to get some of its ducks lined up to ensure that they're all pushing in the same direction. And so there are still friction. There's still friction in things like as we said, the R&D tax credits and reversals around the Angel Group things. And but also we need more clarity around the sort of the pension fund reforms as well. I think the Mansion House pension reforms that they want to put through. So it's they're great, and I think it's a great idea, and I think they should be pushing forward. This is just how it gets delivered, and some more clarity around the application of that, and how those pension funds are going to deploy that money into the local economy, because they're and what the mechanisms are going to be for doing that, because a lot of them are small deals or small amounts of money. They're going to have to find a way to deploy it, and I've got lots of thoughts about how they can do that, but there is they need to come up with a coordinated solution to doing that. And so there are things to be sorted out. There are certain things to be said. I mean, I think they made a lot of announcements around things that they want to do, and bodies and advisory boards and things that we're going to do in the next year or so. And so it's just making sure that they materialise.
I think there was an interesting comment made that around the tech sector in particular, that a lot of what was said yesterday could have been said by Rachel Reeves, the Shadow Chancellor, and there does seem to be an increasing similarity around investment and control of this sector from both parties. Do you think that that's part of a widening consensus around what needs to be done? And as you say, Ben, it's more now about the ability to manage it and to project manage it and to implement it, rather than any particularly wide change in terms of policy thinking.
Yeah, I don't think so. I don't think anyone can argue with whatever the side of the fence you're on. I don't think a lot of things being implemented or the conversations going on could be argued with. They're not. They're positive for the economy. They're positive for the tech sector, particularly, obviously the area that we're particularly interested in. And I'm sure there's tweaks around the edges, and there always are, from whichever part of the political spectrum you come from. But these are all things that are positive, and they're injecting capital and into areas where we are, in a lot of cases, are leading, are world leading. We are, our universities are generating incredible spin outs. We just need to make it easier for them, and no one can argue with that. And so if there's any reforms that need to be done that can oil those wheels, I don't think they can, anyone's going to argue against that. So you are going to see a coming together of policy, I think, depending, irrespective of whether you're Conservative or Labour or whatever.
Pippa, sorry, Pippa.
This was a pre-election budget, and some of the measures that were announced, for instance, the new ISA, £5,000 a year ISA, that's only to be available for investment in British companies. That's a consultation. So there is no commitment yet to bring that in. There's a consultation as to how to bring it in. And this is the last budget for the Conservatives before the next election. And I don't think anybody is surprised at the predictions that they won't get back in. Now, you know, whatever your leanings, you have to accept the facts here, and it'd be interesting to see where we go with that. But some of what was announced, of course, could be changed. But Labour have said many things that are similar to what was announced yesterday. You know, the Chancellor yesterday, it's not relevant to the tech sector particularly, apart from attracting talent, but a big change to the non-dom tax regime, which is exactly what Labour said they were going to do. So they've made a massive change to that, and as Labour said they would. So yes, some similarities.
Yes, very interesting. I certainly feel that we've helped people with a bit of additional understanding of what happened yesterday. As you alluded to there, Pippa, there is an election on the way, maybe May the 2nd, maybe October or November, but definitely this year, almost certainly this year. We may well see a change of government, and we'll see what that brings as well. But thank you both very much indeed for joining us today and sharing some of your knowledge. I'm Robert Hillier. Thank you to Pippa Clarke of Bishop Fleming and to Ben Cooper of Tech Southwest. And I have no doubt we will do this again. Thank you.
Thank you.
Thank you.